Good afternoon, everyone. We're just going to start by looking at where we can find the um, cash flow statement question bank. So I'm just going to look at our Blackboard website initially. So as you know, our content per topic is where we post all our class recordings and any documents that we use during the class recordings or during the classes. So that is our main working area. But our question bank and all the various question banks are actually under the content general. So I'm clicking on content general. You'll see there are various folders there, a welcome letter, subject guide, you all know all this. So if we go to notes and question banks, the one that will be right at the bottom on your side now will be the one called statement of cash flows question bank. So if I click on that, it'll open it. You can download it. You can view it on Blackboard if you wish. So that is what we have. If it'll load eventually. So there we've got the format and the layout of the statement of cash flows. If I scroll down, you'll see here there's a note. We are only doing the direct method. Please ignore that note. You'll see a little bit later why. We are actually doing the direct method, but in a slightly adjusted way. We'll talk about that soon. And then we've got the various questions there, right? All the questions that we need to go and have a look at. Right, ladies and gentlemen, I'm going to display something different now. Um, well, something similar, but not exactly the same thing. So I'm going to display a little Word document that also contains the format of the statement of cash flows, but at least in the Word document, we can type a few things in, we can adjust a few things. So let me just go and find that. It'll take a second or two to show on your side. Let us just wait for it to come up. There we go. Okay, so that is typically the layout. Now, ladies and gentlemen, let us talk about the statement of cash flows. But first of all, I'm going to take you all the way back to the beginning of the year. At the beginning of the year, you'll remember we started with a conceptual framework, and then we just right after that we discussed the IAS 1, which is the presentation of financial statements. Now, when we did those two topics, ladies and gentlemen, what did we say? What is the big difference between the first four statements that are covered in the presentation of financial statements, in other words, IAS 1, and the statement of cash flows, which is not part of IAS 1. It has its own financial reporting standard, IAS number 7, IAS 7, International Accounting Standard 7. So what is the big difference, ladies and gentlemen? What system, if you can type in the chat for me, please, what system does the other four financial statements, in other words, your statement of comprehensive income, your statement of changes in equity, your statement of financial position, and the notes to the statements, what are they based on? On what system are they based on that the statement of cash flows is not based on? If you can type that for me, please. Accrual, there we go. The accrual basis, accrual method, accrual. 100% spot on, ladies and gentlemen. So when we drew up our financial statements, all the other financial statements, we applied the accrual method or the accrual system or the accrual basis, as you have all answered correctly there, right? But when we draw up the statement of cash flows, that is quite different. There we actually do not want to use the accrual system. In fact, you'll see later on one of the techniques that we are going to develop is to actually nullify or cancel the effect of the accrual system, right, ladies and gents? So what is the statement of cash flows? The statement of cash flows is a presentation of where our money came from and where our money went to. So it's all about the money, the money, the money, the money. It's not about income. It's not about expenses. It's not about assets. It's not about liabilities. It's not about equity. So it's not, it has nothing to do with those five basic elements, right? Here we are focusing on cash. Where did the money come from? Where did the money go to? Now, the International Accounting Standards Board, which basically issue these documents, which we call the standards, they've obviously done some analyses many moons ago. And initially, when they came up with the first version of a presentation of where the money came from and where the money went to, it was called the Statement of Source and Application of Funds. So you'll still probably see that I'm sometimes referring to the source of funds or the application of funds. It's just a bad habit. About 30 years ago already, they changed the name from the Statement of Source and Application of Funds to the Statement of Cash Flows. So in any case, having analyzed a company's source of money or source of funds and a company's application of those funds, it has been decided that, or it has been found, I should rather say, that you can basically distinguish between three typical activities within a company. And ladies and gentlemen, I know I'm going to make this available to you on Blackboard, but you still need to have some stationery, pen or pencil, and a notebook or some paper, because you'll have to make a few notes just to have your own experience of what we are talking about, right? So, ladies and gentlemen, what are the three main areas that we can find within any kind of business? Right? First of all, they say operating activities. Now, what are the operating activities, ladies and gentlemen? The operating activities are basically your normal day-to-day activities, those kind of things that happen within a business and that does not affect your financing and does not affect your investing activities, because those are the two other activities, right? So our first one is operating activities, and that is also the first section of our statement of cash flows. We'll see the statement of cash flows. We're now just discussing the main statement of cash flows. Later on, we're also going to look at a note. So our first section, we are going to give a heading, cash flows from operating activities. So that is one kind of activity. We'll see when we analyze that operating activities a little bit later today that itself consists of two sections. We'll talk about that soon. Let's just talk about the three main activities first. So operating activities, ladies and gentlemen, that is our first section. And like we said, we're going to subdivide that in two subsections. Then another kind of activity, ladies and gentlemen, where we can get cash from, but where we also have to sometimes invest cash into, is what we refer to as our investing activities. Right, so that is going to be our third main section. We're going to give it a heading, cash flows from investing activities. Now, I'd like you to type in the chat for me there, please, ladies and gentlemen. When we talk about investing activities, what does that really relate to? I know this is a hard question to answer, but I'd like to see you at least attempt a few things. And this is where you also have to make a few notes. So when we talk about investing activities and we try and relate it to our statement of financial position, what kind of activities or what kind of exactly? Thank you, Tim Visa. Thank you, Vimbanashi. Exactly. Thank you, Lisa, as well. Sorry, I missed you right at the top there. It relates to non-current assets, right? So anything, any cash that you derive from investing activities, in other words, when you dispose of some of your non-current assets or where you utilize cash for the acquisition of non-current assets. This is where the cash flows will be indicated, right? We'll indicate it there. So that is the first thing that we must realize. Investing activities relate to our non-current assets. Now, if you can give me maybe just two examples, there are many, but if you can just give me two examples of non-current assets. There we go. There we go. Investments, fixed deposit. Yes. So motor vehicle, there's another one. Thank you all for those answers. Vehicles, equipment, right. So really, in a nutshell, it is those items that we will see on the face of our statement of financial position under non-current assets. So they will be property, plant, and equipment. That is one major category. And that includes things like motor vehicles, land and buildings, and so forth, right? You remember from last term, we said that is what we call biological assets. Thank you, Lise, like sheep or vineyards, right? So any property, plant, and equipment, biological assets, uh, financial assets, any movement, cash movement therein will be indicated there, ladies and gentlemen. But now, another note that you must now already take here, please. Remember, this is the statement of cash flows. It is not the statement of financial position. So it is not enough to simply write here property, plant, and equipment, or property, or land, or buildings, or vehicles, right? You cannot just describe it as such. You must say, what about the vehicles, or what about the land, or what about the biological assets? Is it an acquisition? In other words, does it represent an outflow of cash? Or is it a disposal of a non-current asset, which will then will result in an inflow of cash? So we've got to describe it more thoroughly, right? Our typical descriptions will be, in the case of an outflow, acquisition of, and in the case of an inflow, disposal of, right? So that is important for us to remember there. Right, let's go to the third major section, ladies and gents. And there I just clicked on something I didn't want to click on. I'm so sorry. I'm just opening up my Outlook here by accident, but I don't want to, because then I get all sorts of distractions. But now I'll have to wait for it to open in order for me to close it. Anyway, you can already see at the bottom. Oh, there it's open. Now I can close it again. Anyway, you can see our third section there, ladies and gentlemen, at the bottom. I'm just going to scroll down. A third kind of activity that was found to result in an inflow or outflow of cash is financing activities, right? Financing activities. So our third major section is going to have a heading that we call cash flows from financing activities, right? Financing activities. Now, ladies and gentlemen, again, I'd like you to maybe just type in the chat for me. What would you see as typical financing activities? A loan. Thank you, Lise. Again, thank you. A loan. Typically, a loan would be a financing activity, right? Where you obtain cash through. Also, thank you, Tando. Shares as well. So, ladies and gentlemen, maybe you can share capital. Thank you, Bimba Nashe. Share capital, exactly. So, ladies and gentlemen, I'm sometimes like a child. I like things that rhyme. So, if you want to make a note, your financing activities deal with own capital, and loan capital, right? Own capital and loan capital. What would represent your own capital typically? In the case of a company, that will be your share capital, as Bimbanashi mentioned there, right? What would represent typically loan capital, as Ulysses mentioned there? a long-term loan, or even debentures. If you issue debentures or bonds, they will represent financing activities. But again, here, ladies and gentlemen, important for us to remember, it is not the statement of financial position. This is the statement of cash flows. So we cannot simply describe it as share capital or as a long-term loan. We have to say what happened to that long-term loan, or what happened to that share capital. Is it proceeds from the issue of shares, which will result in an inflow of cash? Is it the buyback of ordinary shares, which will result in the outflow of cash? That last part, which will result in, you don't have to type that. Okay, you just need to say, let's maybe look at another example. The redemption of redeemable preference shares. Right, so we've got to say what happened to it. And while we're on this topic, ladies and gentlemen, we've also got to get a protocol or a convention, if you wish, for ourselves. You can see that this specific statement only has one column. It's not like a journal, a general journal, which has a debit side and a credit side. It's got one column for this year, and it'll have another column for last year. So clearly, ladies and gentlemen, we'll have to have a convention to indicate and to show to the user of the financial statement which ones are inflows of cash and which ones are outflows of cash. Now, ladies and gentlemen, if it's an inflow of cash into your business, do you think that's a good thing or a bad thing? You can just type good or bad. If it's an inflow, it's a good thing. Yes, thank you. We are all happy when there's an inflow of cash into the business. It's a good thing. Thank you. A positive thing, ladies and gentlemen. And there I've given it away. So if it is an inflow of cash, are you going to indicate it as a positive figure or a negative figure? Positive, 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 because it's a good thing. It's a positive, right? Ladies and gentlemen, if there's an outflow, if there's an outflow, is it a bad thing or a good thing for you as a business? It's a bad thing. You don't want too much money flowing out. You want more money flowing in. So it's a bad thing, ladies and gentlemen. It's a negative thing, and there we've given it away again. So if you are presenting this statement of cash flows and there's an outflow of cash, are you going to show it as a positive or a negative? A negative. Thank you, ladies and gentlemen. And that is extremely important, to do that correctly, not only from a test point of view, but from a test point of view as well. Because if it should be a negative and you don't show it in brackets, you're not going to get the mark. But also for this statement to make sense, if you add up all the positives and you deduct all the negatives, then it should actually work out. It should add up correctly, right? So please make a note of that. It is important to indicate your inflows as positives and your outflows as negatives. Okay, so those are the three main kinds of activities: operating activities, investing activities, and financing activities, right? Three sections. Then we get a fourth section, ladies and gentlemen. We refer to that as the reconciliation section. The fourth section is this part here at the bottom, right? This part there, our reconciliation section. So that is basically a fourth section, fourth and final section of this phase of the statement of cash flows. Now, ladies and gentlemen, I don't know why, but sometimes students go and change the order of those sentences around. I don't know if some of you have been taught at school differently, but please, this is the correct way to do it. Your first subtotal is going to be, if it's a positive, it's going to be a net increase in cash and cash equivalents, right? That is how we have to describe it. There's no other way of describing it, ladies and gentlemen. You're not going to describe it as increase in bank, because it doesn't only include bank, it includes your cash, your petty cash, your cash floats, various bank accounts, savings accounts, as long as it's a current savings account and not a fixed deposit that you can only lay your hands on in 2 years' time, because then it's part of your investing activities, as you can probably realize. Right. So the first one will be to add up the subtotal from our operating activities and the subtotal of our investing activities and the subtotal of our financing activities. We type it in there, right? If it is a negative figure, ladies and gentlemen, then obviously we are going to describe it as a net decrease in cash and cash equivalents. Then, ladies and gentlemen, our next one is to go and have a look what was our cash and cash equivalent balance at the beginning of this financial accounting period. Now, there you can describe it as cash and cash equivalents at the beginning of the period or at the beginning of the year, as long as it is a full financial year. So that is basically a free mark in a test situation. It's very easy to get that figure, because it comes straight from your statement or from your trial balance even, right? Or your statement of financial position. It'll just simply be the sum total of all accounts and all cash that make up your cash and cash equivalents at the beginning of the year. And then you end this statement, ladies and gentlemen, with your final total of cash and cash equivalents at the end of this financial accounting period. So there we are going to describe it as the cash and cash equivalents at the end of the period or at the end of the year, if it is a full financial year. Right, ladies and gentlemen, so let's please keep it in that order. Um, let's maybe now just pause for a few seconds or maybe a minute or so. I just want to see, are there any questions at this point in time from you? I can already see that some of you, or I can sense that some of you have already looked at that little recording we made available on Sunday. So any questions you want to ask at this stage? No questions? It doesn't seem so. Okay, ladies and gentlemen, now let's maybe just talk about the direct method and the indirect method. Um, originally, when it was still the statement of source and application of funds, there was only one method, and that method still lives with us today, but we call that method the indirect method, right? So the way that the old source and app, as we used to call it, was drawn up, is now with us still, but it's called the indirect method. This way that we've just had a look at, this what we are going to use as the face of our statement of cash flows is referred to as the direct method, right? The direct method. We'll see a little bit later, and this is quite important for us to understand. We'll see a little bit later that when you draw up a statement of cash flows, irrespective of whether you use the direct method or the indirect method, the only difference is going to be how you determine this figure. This figure. The only difference between the two is how we arrive at the cash generated from operations. The rest of the statement is exactly identical, irrespective of which method you use, right? So if you use the direct method or if you use the indirect method, this section is going to be identical. This section is going to be identical. This final reconciliation section is going to be identical. So the only difference between the two is how you arrive at this figure, the cash generated from operations. Now, ladies and gentlemen, when it comes to this section, Perhaps just before we discuss this section, let me just scroll down to the note. So the modern trend in business is to present the face of your statement of cash flows, like we did here, on the direct method, right? We present it on the direct method, but then we also present a note to the statement of cash flows where we also show this section, this cash generated from operations, by using the indirect method, right? And that is the note that we are going to discuss later on today. As you can see there on page 2 of your notes, there's something called the notes to the statement of cash flows for the year ended, whatever the date is. And then we are presenting the cash generated from operations on the indirect method. Right, ladies and gentlemen, we're going to fill in some words here later on today so that we basically populate it, but we're going to discuss them as we do that. The main point that I just want to make out here, ladies and gentlemen, is that you can see this note ends with a description of cash generated from operations. So it's exactly the same description and therefore the same figure that we are going to find on the face of our statement of cash flows. So this note, and we're going to analyze it later, obviously, ends with cash generated from operations, right? So that clearly must be the same figure as what we have here on the face of our statement of cash flows, which is also described as cash generated from operations. So those two figures must be the same because the description is the same, right? Let me just pause there for a second. Are you all clear on that? Just a yes or a no. You all clear on that? That note ends with cash generated from operations, and that is also a figure on the face of your statement of cash flows. Happy? Happy? Yes, yes. Okay, perfect, perfect, ladies and gentlemen. Okay, now let's have a look at our operating activities section. Perhaps just one thing that I've got to emphasize here, ladies and gentlemen, you can see here the title or the heading of that section is cash flows from operating activities. But here, this description is not cash generated from operating activities, and please make a note of that. This is cash generated from operations, not activities, operations. Now let's find out the reason for that. Why is that, ladies and gentlemen? It is because this section, this cash flows from operating activities, can be further subdivided into two sections. Two sections. This is our first section, the first 3 lines there. That is our first section. Those lines purely deal with the operations. Now, what is the operations of the company or the business for that matter? It is its wheelings and dealings with its customers and its wheelings and dealings with its suppliers and employees, ladies and gentlemen. So, in effect, your operations are your day to day normal trading activities. Whether you are a manufacturer or whether you are a service business, whether you are a retailer or a wholesaler, it doesn't matter. This operations section deals with your normal, ordinary, day-to-day trading activities. I hope that is clear, ladies and gentlemen. So that is our first subsection of the operating activities section. So the first subsection deals with operations. Then we get the further subsection, this one here, which could potentially consist of 5 items. We'll discuss them just now. This is what we refer to sometimes as our so-called other operating activities, right? So the first 3 lines there, that represents our operations, And then the other lines below that, that represents our so-called other operating activities, right? So you can see they are not the same. Whereas your operation deals with your day-to-day normal trading activities, these items here below, they are also regarded as operating activities, but they do not deal with your day-to-day trading activities. So they do not deal with your wheelings and dealings with your customers or your wheelings and dealings with your suppliers and employees. They are slightly different, right? They are also regarded as operating activities. There, 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 there is a debate. You can read it. It's in your textbook. It could also potentially be shown as as other activities, but I don't want to go there because that might become confusing. So let us just regard that as so-called other operating activities. Now, ladies and gentlemen, maybe I can just pause there for a second again. Any question from your side at this? Doesn't seem like it. Okay, so far so good then. Now, ladies and gentlemen, this is again a good time to make a little note. Let me just see if I switch on my microphone again. Yes. This is again a good time to maybe make a little note. There are only five, a maximum of five possibilities that can be shown under this subsection, which deals with our so-called other operating activities, right? There are only five possibilities, and those five are the ones listed there. It can only be interest received, or dividends received, or interest paid, or dividends paid, or income tax paid, right? So it can only be a maximum of those five. Sometimes if the company did not receive any dividends, obviously then it won't be disclosed because there is nothing to disclose. Or if the company is so fortunate that it hasn't paid any interest during the course of the year, obviously then it's not going to be disclosed because there's nothing to disclose when it comes to interest paid. However, ladies and gentlemen, what we now have to do, now we have to be very, very alert. We've got to be very alert. We said earlier, when we started talking about the statement of cash flows, that this direct method which we use as the face of our statement of cash flows, does not contain any incomes. It does not contain any expenses or assets or liabilities or equity for that matter, right? It only discloses the flow of cash. Now, ladies and gentlemen, I'm not a linguist, but at least I know what a verb is. And I'm pretty sure you all know what verbs are, right? So if we look at that statement there, what is the first line there under our other operating activities? It is not interest income, ladies and gentlemen. Where do we find interest income? Remember, in financial accounting, we as accountants, we never repeat the same information a second or a third or a fourth time. Every time we present information, it is new information, right? So our interest income would be part of our revenue. So that means it will be part of our statement of comprehensive income. That is not necessarily same what we are presenting here. Here we are representing or presenting the cash flow. So therefore we do not describe it as interest income, we describe it as interest received. In other words, the amount of money that landed in our bank account because of interest income. So there's a link between interest income and interest received, but they are not identical, not necessarily identical, because interest income has been derived by using the accrual system. So there's possibly interest that was due to you at the beginning of the year or due to you at the end of the year that did not land in your bank account at that point in time, right? So there could be a difference. And later on, we'll see which method or technique we are going to be using to eliminate the effect of the accrual system, right? But at this point in time, it's just very important that we understand that they are not the same. Let's look at the second item there. The second item, dividends received, ladies and gentlemen. Now, that does relate to an income. Now, this is not rocket science. If you can just type in the chat for me, please. To which income would dividends received be closely related to? Dividend income. Thank you, Siulise. Perfect. Thank you, Vimbanashe. Exactly. It is closely related to dividend income. But as you know, dividend income is part of our revenue. And revenue is part of our statement of comprehensive income. And now we are not drawing up the statement of comprehensive income. We are drawing up the statement of cash flows. So it's not the dividend income that we are going to disclose here. It is the dividends that we have actually received. In other words, the money, the cash, or the funds, if you wish, that landed in our bank account because of dividend income, right? Again, same scenario. There could have been dividends owing to us at the beginning of the year, or there can be dividends owing to us at the end of the year that we haven't received yet. But that has to do with the dividend income because it has been deducted, it has been derived by using the accrual system. But here we are only interested in the cash flows. Right? Pardon the pun there, it was unintended. Same now. If we look at the third item there, ladies and gentlemen, the third item, dividends paid. Sorry, interest paid first. The third one, interest paid. Again, if you can type in the chat for me, to which expense? Now, this, if it's paid, it means it must be related to an expense. To which expense is this closely related? If you can type for me, please. Interest expense. Exactly. Thank you all. You get the idea. You get the drill now, right? So your interest paid is going to be the cash flow. Your interest expense is the expense for interest, which we calculated by using the accrual system, right? Here, we are not interested in the interest expense. We are now going to disclose the actual cash or money that went out of our bank account because we incurred interest expense, right? So again, it's not necessarily the same amount. It could, in most cases in practice, it will be a different amount. Again, because there might be interest that you have accrued at the end of last year or interest that you've accrued at the end of this year, right? But the interest paid reflects the money that flows out of our bank account because of the interest expense. So, ladies and gentlemen, once again, I want to emphasize this very, very clearly, that you have to use the words if it's an inflow, interest received or dividends received. If it's an outflow of cash, you have to use the word interest paid or dividends paid or income tax paid. Right. Now, dividends paid, ladies and gentlemen, that's our fourth one. That doesn't actually relate to an expense. It relates to a distribution of your retained earnings. So that is a figure, or there is a figure that is closely related to dividends paid, which we find in our statement of changes in equity. So if we think back to our statement of changes in equity, which line item will be closely related to dividends paid. What did we call that in our statement of changes? There we go. Thank you, Sulise. Thank you, Asimahle. Right. Dividends declared. Right. The dividends that we've declared, we have shown, we have disclosed in our statement of changes in equity. But here, we are going to disclose the amount of dividends that we have paid during the course of the year. In other words, the money that flowed out of our bank account because of payments to our shareholders. You remember when we declared a dividend, when we did share capital in the, what was it, the second term, when we declared the dividend, we debited dividends declared and we credited shareholders for dividends. In other words, we raised a liability. What is that process called? That is accrual, right? So we accrued the dividend that we are eventually going to pay, right? But at that stage, we just declared it. In other words, the present obligation now exists towards our shareholders, whether they are ordinary or preference shareholders, depending on which kind of dividend was declared. So we accrued it at that point in time. And then you remember later on, we actually pay it. So this figure on the face of our statement of cash flows will represent all those times that we've made payments to the shareholders, not when we declared the dividends. Then lastly, the last one in that other operating activities section, ladies and gentlemen, the fifth and final possibility, income tax paid. Right, so if you can type for me in the chat there, to which expense is that closely related? Income tax expense, there we go. Thank you all. Oh, you are alert, I must admit. Thank you so much. So you remember way back in the first term when we drew up our various financial statements, all of them except for the statement of cash flows, we said it's quite important that you describe it as income tax expense and not just income tax, because there are many kinds of income tax accounts. There's your income tax expense. Here we are disclosing the income tax paid, in other words, your provisional tax payments made to the Revenue Service, or a top-up payment. This is not when you accrue your income tax expense. This figure relates to the amounts that you have paid to the various revenue services that you are dealing with. Right. So again, very important that we describe it here as income tax paid. But on the face of our statement of comprehensive income, we had a line item, as you've correctly stated there, income tax expense. Why is that an expense and not a paid? Because that was calculated using the accrual system. You remember we estimated our income tax expense at the end of the year in order for us to complete our financial statements. Okay, ladies and gentlemen, so that is the so-called other operating sections, other operating activities section. So now let's just go back to our operations section, this one here. The operations section. So when we are using the direct method, we are simply going to have two line items that will then result in the cash generated from operations subtotal. The first line item is our cash received from customers, right? Or you can call it cash receipts from customers if you wish. In other words, that will be an inflow. That will be the money that you've received from your customers. Perhaps this is also a good time to make a little note, ladies and gentlemen. That will be any money that you receive from your customers, whether it is money that you've received from cash sales, or it could be money when your debtors pay your accounts, right? That is the reason why that line item is called cash received from customers. You can clearly see it's not called cash received from debtors. right? Because that would limit it to debtors. It is called cash receipts or cash received from customers because it includes your cash customers as well as your credit customers. So, ladies and gentlemen, the amount that you've received from your customers will be partly from cash sales and partly from the payments, the remittances that you receive from your debtors, right? So it's a combination of those two. That is why it is called cash received from customers. The next item there, ladies and gentlemen, is cash paid to suppliers and employees. So maybe let's just analyze that. Cash paid, that is clearly already indicating a flow of cash. Just like the cash received from customers already indicates a flow of cash. Right, cash received would represent an inflow, cash paid would represent an outflow. So clearly the cash received from customers will be a positive figure, and the cash paid to suppliers and employees will be a negative figure. Right. Now, the first thing we can talk about when it comes to that second line item, cash paid to suppliers and employees, which suppliers are they referring to? Which suppliers? Right. That is perhaps the first question we've got to answer for ourselves. And basically, the answer there, ladies and gentlemen, the suppliers of anything. Okay. Anyone, any business or person or entity that supplies something to your business is a supplier. So, good time again to make a few notes, ladies and gentlemen. That will include your suppliers of inventory. If you are a manufacturing business, that will be your raw materials, the suppliers of your raw materials. Or if you are just a merchant, in other words, you buy and sell merchandise, buy it to sell it at a profit, it will be the suppliers of your finished goods, the complete merchandise as you're going to sell it, but also the suppliers of any other goods or services to you. So the suppliers of your stationery, for instance, right? Or the suppliers of your internet services, or the suppliers of your telephone services. So you can already see that any kind of expense that you've incurred, which will result in an outflow of cash, will be a cash payment made to some sort of supplier. Now, in financial accounting too, we are not going to reconstruct, we'll talk about reconstructions a little bit later. To be able to calculate the cash paid to suppliers and employees, you'll have to go and reconstruct a lot of accounts. Mrs. Kies can confirm that because we are doing this in Financial Accounting 3, and she is involved in Financial Accounting 3 as well. So there we will have to go and reconstruct our inventory account. We'll have to reconstruct our creditors account. We'll have to go and reconstruct basically all our various kinds of cost, operating cost and administrative cost, whatever they are, all the various expenses if we haven't actually allocated them to cost functions yet. But that we leave for Financial Accounting 3. So in Financial Accounting 3, within the first few weeks of the year, you are going to revisit the statement of cash flows, and then you're going to do a few additional tricks, right? Amongst them would be to go and reconstruct all the accounts that make up the cash paid to suppliers and employees, right? Employees clearly are the staff employed by the company, your workers, in other words, right? The amounts that you pay to them for salaries and wages, staff benefits, and so forth. So, ladies and gentlemen, how do we then go about it in Financial Accounting 2? In Financial Accounting 2, what we do, we first complete the note, right? We first complete the note. When we are going to do our various exercises, we'll see exactly how we put this into practice. We're going to do our note first so that we arrive at this figure, so that we arrive at our figure for cash generated from operations, right? Then we simply transfer that amount there over to the face of our statement of cash flows. We insert it there next to cash generated from operations, the same, exactly same description. Then, ladies and gentlemen, then we go and calculate our cash received from customers. We're going to talk about that in about 60 seconds. Excuse me. Then we're going to calculate our cash received from customers. And then, excuse me, I've got a frog in my throat. Then the difference between your cash generated from operations and the amount that you calculate as cash received from customers will then simply be your cash paid to suppliers and employees. So in financial accounting 2, we determine cash paid to suppliers and employees simply as the difference between cash generated from operations and the cash receipts from customers. Cash generated from operations, we would have calculated when we drew up the note, in other words, the indirect method, and cash received from customers is quite easy to calculate. We're going to tell you how in about 30 seconds from now. And then when we do the exercises, we're going to indicate by using practical examples and real figures exactly how we go about it. Anyway, ladies and gentlemen, this brings us to our technique or method for determining cash flows. Right, ladies and gentlemen, really, when one thinks about it, all you need to draw up a statement of cash flows is the rest of the financial statements. Right, so you need your statement of comprehensive income for this year. You need your statement of changes in equity for this year. You need the opening and closing balances for the year from your statement of financial position, and then you might have to refer to some of the notes as well. If you've got all the other 4 components of this set of financial statements, then you've got all the information you need to be able to draw up this statement of cash flows. Now I'm going to ask you quite a few trick questions, ladies and gentlemen. Let's see again how alert you are. I'm very, very impressed so far. You've got everything spot on. So you've clearly thought this through already. Now, when we sell on credit to our customers, so now I'm just talking about the first line item, the one that deals with cash received from customers, right? We just want to analyze that. We just want to get the philosophy behind our technique. If we look at cash receipts from customers, that line item, as we've said a few minutes ago, we want now to disclose the amounts that we've received that's in our bank account or lying in our safe in the form of cash. In other words, the money that we've received from our cash sales or from payments from our debtors, right? We want to determine that. So, ladies and gentlemen, we have to go and see where can we find the necessary information in the rest of our financial statements to enable or empower us to draw up this statement of cash flows. So, my first little trick question, ladies and gentlemen, if you sell to a customer which is a debtor, you sell on credit, in other words, you are going to credit sales, we all know that, but on which account do you accrue that credit sale? If you can type that for me as a first trick question, please. Debtors journal, thank you, Lisa. Debtors, thank you, Vimbanashe. Thank you, Asemashle. Receivables, right? So you can call it your trade receivables, you can call it your debtors control. They're all different names for the same thing. So, ladies and gentlemen, you have accrued that sale on your debtors account or your receivables account. Let's just, for the sake of our discussion, just call it our debtors account, right? It's much easier to pronounce than trade receivables. So you would have accrued it there, right? So clearly, when we look at our statement of financial position and we see a figure there, cash, trade and other payables, part of that will be trade payables, and that really is your debtors, right? So we can find that. We can find the opening balance. We can find the closing balance. We also know that our total sales for the year we can find in our statement of comprehensive income. But what are we looking for now? When we draw up our statement of cash flows, what are we looking for now? We're looking for the cash flow. We're not looking at sales. We're not looking for sales, right? We're not looking at balances. We are looking at the amount of cash, funds, money that we have received from our customers. Now, as you've correctly stated there, ladies and gents, thank you for those answers. As you have so correctly stated there, the accrual of the sale is recorded in your debtors account. What else, besides opening and closing balances, what else is also recorded in your debtors account in your ledgers? Exactly. Thank you, Vimanashi. In other words, when your customers pay you, where do you record it? Which account do you debit when you receive money from your customers? Bank, as Vimbanashi said there, right? So you're going to debit bank. Which account are you going to credit? Your debtors account. Thank you. Thank you, Lisa. Exactly. Right. So in other words, ladies and gentlemen, what we are working towards here now is that your debtors account has got a little bit of magic, because on your debtors account, at least two kinds of activities will be recorded. We know there's an opening balance, we know there's a closing balance, we know there can possibly be credit losses and so forth, but that is an account where at least two very important events are recorded. Firstly, the accrual of the sale. In other words, crediting the sales account, debiting debtors. So the accrual of the sale, but also the payment made by the debtor is also recorded on our debtors account. So that little bit of magic that we are talking about is that on that debtors account, we two very important events are recorded: the accrual of the sale, but also the receipt of the money, ladies and gentlemen. Now, if we want, what we want to disclose here is the receipt of money. Clearly, that is what that line item indicates, right? This is what we want to disclose. So, ladies and gentlemen, if we want to determine what the amount of money was that we have received from our customers, we can use our debtors account to determine that. Therefore, we have to use that account to see what we have, what can we get from our other financial statements that relates to that account, and then what can we then further do to determine the flow of cash. Anyway, to make a long story short, this is the technique that we are going to be using. We are going to reconstruct the account. So if you can make a little note there somewhere again, our technique for determining cash flows will be the reconstruction. Perhaps you can make a complete note of this. I think this is important enough that I must repeat this once or twice slowly. So the technique that we are using to determine the flow of cash for the purposes of this statement is to go and reconstruct the ledger account on which the accrual took place. Why? Because the same ledger account where the accrual took place on, the flow of cash would also be recorded. Now, debtors is perhaps the most obvious one. We're going to, when we do the exercises, the various questions, excuse me, we're going to look at exactly how we are going to do this. But as a matter of, just because debtors, we're discussing it now, let's maybe just complete this little argument, ladies and gentlemen. Your opening balance, if you want to reconstruct your debtors account, your opening balance, you will find in which statement? You'll find it in the comparative column of your statement of financial position. Your closing balance for that debtors account, where will you find that? You will find that in the current year column, also of your statement of financial position. So from your financial statement of financial position, you can get your opening balance for debtors and you can get your closing balance. So what do we need? Now there are two things, two kinds of events that are outstanding. What are those two kinds of events? We've made a song and dance about it already. The accrual of the credit sales and the receipt of the money from our debtors, right? Can we find one of those two in any of the other statements? Yes or no? Remember, we preferably only want one unknown variable. Yes, we can. We can find the sales. We can find the credit sales because that will be disclosed as part of our statement of comprehensive income. It might be in your revenue note, so it might not be on the face of your statement of comprehensive income, but then it'll be in a note that relates to the statement of comprehensive income. In other words, your revenue note, right? So we can find that. That means then at the end of the day, we've only got one unknown quantity, and that is the amount that we've received in cash from our debtors in that case, and then we just add our cash sales to get the total amount received from all customers. Right, ladies and gentlemen, I hope that makes sense. So our technique is to go and reconstruct the account on which the accrual took place. Now let's go and borrow a few things from mathematics. Most of you would have had mathematics, at least at school. So let us go and borrow a few principles. If you have one unknown quantity, if you've got one unknown quantity, how many equations do you need to solve that quandary or that sum? How many equations do you need if you've got one unknown variable? Anybody wants to take a chance? Then you only need one equation. Okay, so let me give, there we go. Thank you, Rita. Exactly. Then you need you only need one equation. So ladies and gentlemen, like in this case where we talk about debtors, what is a ledger account? A ledger account is really nothing other than an equation. If you think about it, a ledger account is an equation because we are using a double entry system. Your total debits must always add up to the same amount as your total credit. So it's an equation. Each and every little ledger account is a mini equation, right? So in this case, if we have our opening balance for debtors, we have our closing balance for debtors, we have the sales, which we can all find from our other financial statements, it means there's only one unknown quantity. It means we only need to go and reconstruct that one ledger account, our balancing figure. This is what it comes down to. Our balancing figure will then represent the flow of cash, or as Tembisa said a little bit earlier, as well as Vimba Nashe, your bank account contra entry, right? Remember, when your contra entry is bank, it reflects a flow of cash. If you debit the bank account, it's an inflow of cash. If you credit the bank account, it's an outflow of cash. But every time that the bank account is a contra entry in any of your ledger accounts, it means cash has flowed in or out, right? Depending on the situation, but it represents the flow of cash, money into your account or money out from your account. Ladies and gentlemen, later on, not today, next week and the week after, when we carry on with our discussions of this statement, when we do some questions and some practicalities, we'll see, especially when it comes to our investing activities and our financing activities, very often we have two unknown quantities, right? We have two unknown quantities. We don't know what the inflow of cash was, or there could have been an outflow of cash. In the case of debtors, you're not going to be paying your debtors, are you? Your debtors will always pay you. So there can only be an inflow of cash. But when it comes, let's say, for instance, to your non-current asset accounts, we know there can be outflows of cash because of acquisitions, but there could also be inflows of cash because of disposal. So there's the possibility that we might have two unknown quantities. And then again, if we go and borrow a little bit from mathematics, if we have two unknown quantities, what is the minimum number of equations that we require to solve it? If you can type for me, if we've got two unknown quantities, two exactly. Thank you, Rita. Thank you, Tembisa. Exactly correct, ladies and gentlemen. So then it means, if we now apply this to financial accounting, that in such cases where we've got two unknown quantities, we might have to go and reconstruct at least two general ledger accounts. Not only one, at least two. We'll see sometimes it might even be more than two. It might be three or four, but usually it's two or more, right? Or not usually, it's always two or more, right? So then we'll have to go and reconstruct more than one ledger account to be able to determine the outflow and the inflow of cash. In the case of debtors, clearly it's only going to be an inflow of cash, so we only need to go and reconstruct our debtors account. Okay, ladies and gentlemen, before we go and proceed to the note, let us just do a general overview of this face of the statement of cash flows. Now, like we said, it's only the cash generated from operations section that differs between the direct and the indirect method. So we are presenting the face of our statement of cash flows on the direct method, and then our note, or one of the notes to the statement of cash flows, will simply be the operations section uh, uh, disclosed by using the indirect method. Okay, so just as an overview, we've got a title. As you know, all statements have got a title. We indicate our reporting currency and so forth. So then we've got four major sections, three of them representing activities. What are those activities? First of all, our operating activities, then our investing activities, then our financing activities. So those three sections indicate the activities which generate cash for us and where we apply cash in. And then we've got a fourth section here at the bottom where we simply reconcile our opening cash and cash equivalents with our closing cash and the cash equivalents, and that the difference between the opening and the closing in your cash and cash equivalents will clearly be either an increase or a decrease in your cash and cash equivalents for that financial year, right? And then we said when it comes to our operating activities section, we can subdivide this into two little subsections. The first three line items deal with your operations, your day-to-day normal ordinary trading activities, which we've said in summary represents your dealings with your customers on the one hand for inflows, and your dealings with your suppliers and your staff or your employees on the other hand, which will be outflows of cash, and that will give us our cash generated from operations. And then we've got a second subsection here. There we go. That second subsection just deals with operating activities that's not part of your day-to-day normal trading activities, but they are still regarded as operating activities. And we've emphasized the received and the paid, right? It's not income or expenses. In this case, it is cash flows. When it comes to the indirect method, when it comes to our note, different story. But we'll discuss that in let's say, about a minute or so. Just before we do that, ladies and gentlemen, let us just pause. I just want to make sure that we're all on the same page. Have you got any questions? You are most welcome to ask it in person. So you can unmute your microphone, you can ask it, or you can type it in the chat. Any questions so far? No questions? All happy so far? Okay, right, then we will proceed. I know there's a lot of theory today uh, because we have to understand the philosophy and the principles behind the statement. We've obviously got to know the structure of the statement as well, the layout, in other words. So there's a lot of information that we have to take in today, but the whole point is it's much easier to understand something than or to do something when you understand it than to do something when you do not understand it. Okay, that goes without saying. I think that is pretty obvious. So the point of today really is for us to understand how this whole statement and its note works, right? Then we can start using practical examples. Okay, so now let's go to the note, ladies and gentlemen. This is quite interesting. We've got the layout there. We're going to type in a few things. So what we see here, the heading there, the heading of this or subheading of this note is reconciliation there, reconciliation of profit before tax with cash generated from operations. Right. That really summarizes what this note is all about. And remember, this is simply the cash generated from operations indicated or disclosed by using the indirect method. So it's a reconciliation of profit before tax with cash generated from operations. Now, ladies and gentlemen, again, a few little tricky questions. They're not that tricky, but who knows? Let's see. Profit before tax, because we got to start with that. They say it's a reconciliation of profit before tax with cash generated from operations. So clearly, just by that little subheading, we know we're going to start with profit before tax and we're going to end with cash generated from operations. So we can see all of that already just in that little subtitle. Okay. So, ladies and gentlemen, if you can type for me, profit before tax, we all know it is a disclosable item. So, profit before tax, in which statement do we find it as a line item? If you can type for me, please. You can use the abbreviation of that statement if you wish. Comprehensive income. Thank you, Silise. Thank you, Vimbanashe. Comprehensive income. Thank you. So your statement of comprehensive income. So, ladies and gentlemen, now you can just tell me yes or no. Very good, very short little answers, yes or no. When you draw up your statement of comprehensive income, do you use the accrual system? Yes, we do. Right. Thank you. Yes. So we know that we use the accrual system, ladies and gentlemen. Thank you so much for all of those answers. So that's the first thing that we've got to realize, that the figure that we are starting this note with, in other words, our profit before tax, that figure includes profits and it includes losses. All those profits and losses, those figures were determined by using the accrual system, right? So that's the first thing that we've got to remember. Profit before tax comes from our statement of comprehensive income, but we've determined it by using the accrual system, right? Then, ladies and gentlemen, now you can also just type for me yes or no. Included. included in that profit before tax? Could there possibly be profits that relate to items that are not part of operations? Trick question, I know, but could there be profits included that do not relate to your day-to-day? Yes, yes. Thank you, Siulise. Yes. Thank you, everyone else. Tando, thank you. So we could have profit on disposal of a motor vehicle there, right? So it is possible that there could be profits included in there that do not relate to your operations. Could there be expenses or losses included in your profit before tax that does not relate to your operations? Yes or no? Again, it's a yes. Thank you so much. Thank you for all those answers. Again, it is a yes. So, ladies and gentlemen, if we want to convert, and this is again a good time to make a few notes because this is a mouthful. This is something we have to get our heads around. If we are going to start with profit before tax, which we know has been calculated using the system, and we know it could include income and expense items that do not relate to operations, right? So if we start with that figure and we want to end with cash generated from operations, it means we will have to go and make two kinds of adjustments to our profit before tax. You can see just after we start profit before tax, there's a little subheading called adjustments for. So really, we've got to go and adjust our profit before tax with two categories of items. The first category of item that we have to go and adjust our profit before tax with, that first category includes any income. Remember, now we're not talking cash flows. Now we're talking expenses and income, right? Please, we've got to get our heads around that. When we spoke about the face of our statement of cash flows, no income, no expenses, only cash flows. Here in this note, we are now not talking cash flows. We are now working our way towards a cash flow, but we are now eliminating certain expenses and certain income items, right? Okay, ladies and gentlemen, so the two categories that we've got to go and adjust for or eliminate are any income items or expense items that do not relate to operations. Which are they? Which are they potentially, ladies and gentlemen? Again, good time to make a few notes. I've said that a few times today. That will include any income item that is part of your so-called other operating activities, right? So it's not part of your operations, it's part of your other operating activities. I'll come back to that just now. So, ladies and gentlemen, if we talk about income and expenses that are not part of operations, how are we going to determine which they are? Well, we'll come back to that in a minute. Okay, so what else? What else? So we said it could include income and expenses that relate to other operating activities that's not part of operations. What else? It could potentially include income and expense items that relate to your investing activities, right? Does that make sense? It could include those items. Give me two examples, please. Two examples of expenses or income, for that matter, that relate to investing activities. You can type for me two possibilities there. There are more than two, but just for the sake of this argument. Let's maybe start with an income item. What is typically an income item that relates interest income? Thank you, Claire. the interest income, we're going to come back to that. That will be part of your other operating activities, right? Part of your other operating activities, but that is definitely something you'll have to go and adjust for. But if we only think about an income item that relates to our investing activities, and remember we said earlier, your investing activities relate to your non-current assets. Yes. So clearly, as Claire also said there, it could be your interest income. Another one could be, this is what I actually was looking for. Another one could be a profit on the disposal of whatever kind of property, plant, and equipment, right? Can you give me an example of an expense that relates to investing activities? This is a harder one, but I think you'll get it. What is typically an expense that is part of our profit before tax, right? It's already included in our profit before tax note, but it's not part of our operations. Amortization, that's a very good one, Claire. Thank you. Amortization, right? Amortization, that is where we write down some sort of an intangible asset, such as our financial assets or intangible assets themselves. So amortization is a very similar principle to another one that we've done last term, in fact. Who wants to talk? Tembisa, we're going to come back to interest on loan. Depreciation, Tando, thank you. There we go. Right. So depreciation, remember, depreciation is an expense, but we do not go and pay for depreciation, right? We do not buy depreciation. We do not sell depreciation. So it is an expense because we are decreasing the book value or net the carrying amount of some sort of an asset, right? So your depreciation is an expense that's included in your profit before tax. So it means you'll have to go and take it out because it relates to investing activities, and you want to arrive at a cash flow which relates to your operations. Okay, I think you get the idea, ladies and gentlemen. So first of all, we've got to go and take out all income items that are included in profit or before tax, and all expense items that are included in profit before tax, right? We've got to take them out. What do we then get? Do we get a cash flow yet? Trick question. Sorry for all the trick questions today. Would that represent a cash flow yet? Or will it still be either an income or an expense? Once we've eliminated expenses that relate to other items, not yet. Thank you, Rita. 100% spot on. You haven't converted it to a cash flow yet. It's still either an income or, either a profit or a loss, right? It's still a profit or a loss, depending on whether it's a positive or a negative figure. But now, once we've taken out, we've adjusted for all income and expense amounts that do not relate to your operations, it means you are now not sitting with a profit before tax or a net profit or any other kind of profit except for an operating profit, right? So it's still a profit or a loss, but that profit or loss that you now have as a subtotal only relates to your operations because you've taken out any income and expense items that do not relate to your operations. In other words, items that relate to other operating activities, items that relate to investing activities, and items that relate to financing activities. Now, ladies and gentlemen, little secret, but it's not going to be a secret anymore because we're going to tell you now. It's actually quite easy to go and find the items that that do not relate to operations when it comes to the other operating activities, because there's still only a maximum of 5 cash flows. Let's just go back to the other operating activities. There's still just a maximum of 5 possible cash flows that we are going to disclose as part of our other operating activities. Now, we've done this little exercise about an hour ago, but let's just go through it again. Let's just go through it again. If you have received interest, in other words, if on the face of your statement of cash flows, you've got interest received, which income item will that relate to? If you can just type that for me again, please. I know that we've done this earlier, but just one or two again. Interest income. Thank you, Lisa. I think you answered it earlier as well. Okay, so if we want to go and do an adjustment now, which income must we go and take out in the note? The interest income, right? The interest income. Let's just do one more, ladies and gentlemen. Dividends received. Dividends received. It's part of our profit before tax because it's part of our revenue, but it does not relate to our operations. So if we need to go and adjust for it, if we need to go and adjust for an item in our note, our reconciliation note, which item do we have to go and eliminate? Which item do we have to take out that is related to dividends received, to the cash flow we call dividends received? Dividend income. Thank you, Lisa. I think you answered that as well earlier. Thank you, Tembisa. I think you too. Okay, so what we have to go and eliminate in the note is not the cash flow, but it is related to the cash flow, right? It is related to the cash flow. So therefore, in the case of the first one, the interest received cash flow, we've got to go and eliminate the interest income. Okay. In the case of the dividends received cash flow, we've got to go and eliminate the dividend income. Right. What about the interest paid, ladies and gentlemen? Is that part of our profit before tax? Yes, the answer is yes. I know I'm answering it myself now, but we are running out of time slowly but surely. So it is the expense. Which expense has been deducted? If you can just stop that, that's the last one I'm going to ask. Which expense have been deducted in arriving at profit before tax that is related to interest paid? Interest expense. Thank you so much. All interest expense. You also know that when we disclose it on the face of our statement of comprehensive income, we normally disclose it as our finance cost, right? Our finance cost. Same difference. There is actually a slight difference, but we'll talk about that in general financial reporting 4. Okay, so then we've got to go and eliminate the interest expense in the note. What about in the dividends paid, ladies and gentlemen? Now, my last 2 trick questions of the day, and then I'll promise I'll refrain from asking more trick questions until next time. Okay. Should we go and eliminate the dividends? What would be the item that is related to dividends paid? We said earlier it's dividends declared. Now you can just type for me yes or no, please. Should we go and eliminate the dividends declared? Now you've got to think very carefully. Yes or no? Should we go and eliminate? No. Thank you, Claire. Thank you, Claire. That is a very correct answer. Thank you, Asimachle. Now, who is going to be brave enough to tell me why we're not going to eliminate that? I'm going to give you 20 seconds if somebody wants to put up a hand and try and explain why we're not going to eliminate that. Who wants to explain it for us? Here we see. Cash does go out and we're working with a cash flow. That's a good attempt. There's no cash flow. Another good attempt. But remember, when there's dividends paid, they are flowing out. Okay, ladies and gentlemen, I do not want to take up too much time with this. The question we've got to ask ourselves, when we look at the profit before tax, remember we started that note with profit before tax. Has the dividends declared been deducted yet? Yes or no? Have the dividends been deducted yet? No. Thank you, Anaziwe. Totally correct. Absolutely spot on. Remember, we are starting that reconciliation with profit before tax. Where do the dividends declared get deducted? Only later on in your statement of changes in equity. So the figure that you use to start your reconciliation, the profit before tax, the dividends declared have not been deducted yet, so you cannot eliminate something that's not in there in the first place. Right. I hope that
Sir,
makes sense. Yes.
but how is dividends paid related to dividends declared? I'm a bit confused on that because declaring shares does not mean like it's a loan, right? It's a liability, I mean. It doesn't
No,
mean
no,
like
it's
you've
not.
paid it.
No,
It's
it's not a
accrued, right?
liability. Yeah, but remember, just first of all, shares are not liabilities, right? They're equity.
Mm, okay, but it's
Okay.
an accrued expense.
Yes, yes. But now, okay, I understand what you're asking. If we think back to the process of the whole life cycle of a dividend, which we spoke about in the second term, I think it was, right? What happens at some point in time, the directors, they recommend a dividend, right? They recommend a dividend. Then that recommendation must be ratified. Ratified, in other words, approved at the annual general meeting or any other meeting of shareholders, right? It can be a general meeting, annual general meeting, special meeting. Anyway, as long as it's a meeting of shareholders and there's a quorum. Then if they approve that recommendation or they can adjust it, then we say at that point in time when it is minuted that the shareholders have approved the dividend, then we say the dividend has been declared, right? And at that specific moment in time, that transaction will be recorded. We now, as you correctly said there, we now have to go and accrue it. How do we accrue it? We debit our dividends declared and we raise the liability. So we go and credit our shareholders, our ordinary shareholders or our preference shareholders, or both if we have declared both classes of dividends, right? But once we've done that later on, maybe tomorrow, maybe Friday, maybe next week, depending on how long it takes us to go through our share register and do all the transfers. We still got to pay the dividend as well. Okay? We still got to pay the dividend as well. It's no use declaring it and not paying it because you cannot go and buy something with a declared dividend, but you can go and buy something with money. Okay. So eventually the shareholders need to be paid the dividend as well. Does that make sense? Does that make sense? So in our statement of changes in equity, the amounts of dividends, you're most welcome, Sue Lise. Now I also know who asked the question. You're so welcome. I'm glad you asked. I always appreciate hearing it from your side as well, personal, in person. So the dividend that has been declared at the annual general meeting will be disclosed in your statement of changes in equity. But when they now next week or whenever they are paying the dividend, they no longer owe it to the shareholders, then it becomes a cash flow, right? then it becomes a cash flow, then it is the dividends paid. Oh, okay, so you're happy. Thank you, Siulise. The main point is here, ladies and gentlemen, those dividends will be paid and the dividends declared will be deducted not from your profit before tax. It'll only occur later on in your statement of changes in equity. Let's go to the last one there, ladies and gentlemen. And like I said, I still have one remaining trick question. Your income tax paid, as you all said earlier, is closely related to the expense we call our income tax expense. But now you can just type for me a little trick question. Think about it very carefully. Should we go and eliminate that expense from our profit before tax? So should we go and take our income tax expense out? Yes or no? We've got one positive. Let's see if we can get 5 or so more answers. Should we go and eliminate the income tax expense? Ooh, I've got you all worried now. Now you're worried. Now most of you are too shy to type something. The question you've got to ask yourself, similar to the dividends declared, has Vimbanashi says no, Rita says no. Now we've got a lot of no's. We've still got a few yeses. We've got a lot of no's. The question you've got to ask yourselves, ladies and gentlemen, that income tax expense, has it been deducted in arriving at your profit before tax? Yes or no? Remember, we're talking about profit before tax. Not yet. Thank you, Claire. Thank you. No, it hasn't yet. Thank you, Rita. Thank you, Janita. Okay, ladies and gentlemen, so the point that we want to make here is if we started the reconciliation with your profit for the year, if we had started, which we are not, but I'm just saying if we had started with your profit for the year, that would mean that the income tax expense has already been deducted, right? But we are not starting with a profit for the year because that gives us an unnecessary extra little adjustment. We are starting with profit before tax. So the income tax expense, the amount that we are taking from our statement of comprehensive income, is the amount before we deduct the income tax expense, right? So therefore, there is nothing to adjust, right? The income tax expense has not been included in the profit before tax, so therefore we cannot eliminate it. There is no income tax expense to eliminate because it's not in there in the first place, right? Does that make sense? If I can perhaps get a yes or no, or a happy face, or a sad face, or a scream. Thank you, Rita. Thank you, Lindiwe. Thank you, Asemakhle. Okay, so if that expense or income, thank you, Tando, thank you all. Supermeze, thank you. So if that expense or income that does not relate to operations isn't in the profit before tax, nice happy face, thank you, Claire, then we cannot go and eliminate it, right? We can only eliminate income and expense items that do not relate to operations that are included in our profit before tax. Okay, so what we've now done, ladies and gentlemen, in our first category of adjustments is to go and eliminate all, let me just scroll down again. Here, we're going to eliminate all those items that are either income or expenses, but they do not relate to operations. So I'm just going to type one or two possibilities there. Let's say depreciation. Another possibility could be impairment loss. Or something like amortization, as you said earlier, or profit on disposal of an asset. But as long as it's an expense or an income item that's included in profit before tax and it does not relate to your operations. Right, ladies and gentlemen, that then gives us a subtotal, which we now call our operating profit. Right, operating profit, because all income and expense items that do not relate to our operations have been eliminated. They've been taken out. So the only profit or loss that remains is the profit that purely, solely relates to our operations. But now we've got to go and make a second major adjustment, ladies and gentlemen, and that is we have to go and eliminate the effect of the accrual system. Okay, let me put it differently. Let me put it differently. What we now have to go and do is we have to change that profit into a cash flow. Right. We've already now, in our first kind of adjustments, we've already created a profit that only relates to operations. But now we've still got to change that profit to a cash flow. Right. How do we do that, ladies and gentlemen? By eliminating the effect of the accrual system. That is what is meant by before working capital changes, and then we've got changes in working capital or working capital changes. I guess the first thing that we have to understand here is what is meant by working capital. For the last time today, hopefully, I'm going to say this is a good time to take some notes. This is a good time to take some notes. What is meant by working capital? Please, ladies and gentlemen, you'll have to write this down. It's probably in your textbook somewhere, but I don't think it's in any of our notes. Working capital, this thing here, that is all current assets, all current assets and current liabilities, right? So it's all current assets and current liabilities except, you can just maybe put in brackets, except for cash and cash equivalents itself, because that is our target. We are working towards a cash flow. So all current assets and current liabilities, except for cash and cash equivalents, that relate to our operations, right? So we're not going to include current assets or current liabilities that do not relate to our operations. We're only going to use those current assets and current liabilities that relate to our operations. Now, if we go up to our face of our statement of cash flows, if we look at the direct method there, we saw that our operations really consist of our wheelings and dealings with our customers and our wheelings of dealings with our suppliers and employees, right? What do we sell to our customers? We sell inventory. What do we buy from our suppliers? We buy inventory, right? So really, if one, I know it takes a few days for all of this to sink in, but if you really look at it, the only current assets, and I want you to type them for me, ladies and gentlemen, there are only two. Which current assets relate to your operations? If you can type a few thoughts for me, please. Inventory and receivables. Thank you, Tanda. You've got both of them. Thank you, Rita, as well. See you, Lisa. Yes, your inventory and your trade and other receivables. In other words, to make it short, your inventory and your debtors. Right, your inventory and your debtors. There's only one current liability that relates to your operations, your day-to-day trading activities. Your payables or creditors. Thank you so much. Oh, so many to mention. Tando, Vimba, Nashi, Claire, Rita, thank you all. Right, so those are the only items that relate to your operation. So we want to go and eliminate the effect of the accrual system from them. Ladies and gentlemen, I know we're going to run a little bit over time. I hope you don't mind, but I know that this is the last class of the day. I think I set the time for the session until 1:15. Hopefully, we'll be done by then. But we are going to go a little bit over time. Thank you, Rita. I'm pretty sure you haven't got another class here. Again, when we describe this, ladies and gentlemen, when we describe these items, we must remember this is not, oh my word, no, 4 o'clock. Sorry, I was just thinking load shedding, but it's 4 o'clock on my side, not 3 o'clock, 4 o'clock. So we're fine. We're fine. Thank you. Again, this is not a statement of financial position. This is the note to the statement of cash flow. So it's not sufficient to simply say inventory or trade receivables or debtors or trade payables or trade and other payables or creditors, right? We have to say what happened to it. So let's say our debtors, ladies and gentlemen, increased from the beginning of the year to the end of the year. Then we are going to say there, what did I say? Debtors or inventory? What did I just say now? I'm sorry, did I say debtors? Thank you. I couldn't remember. Okay. Anyway, let me just go to the next line. Right. So let's say we've got an increase. But an increase in trade and other receivables. In other words, our closing balance at the end of the year is more than our opening balance at the beginning of the year. Then it means there's an increase in trade and other receivables, right? From the beginning of the year to the end of the year. That is a very, very easy sum. That is an extremely easy sum. You just deduct the one from the other, right? So you take your opening balance as it appears in the comparative column in your statement of financial position. You deduct it from the amount that appears in the current year column. Very easy. What is not so easy is to now go and determine whether you've got to show it as a positive or do you have to show it as a negative? That is the big question. Now, there are many ways that we can go about this, ladies and gentlemen. I know that both Mrs. Moore and Mrs. Kies will probably in the future show you it by means of ledger accounts and so forth, but I just want to go through the philosophy of it. If there's an increase in your trade and other receivables from the beginning of the year to the end of the year, did your debtors pay you better this year than last year, or did they pay you worse? If you can type for me, better or worse. Sounds like a marriage vows, for better or for worse. We've got a little bit of a difference of opinion, but I think there are more worses than there are betters. Remember, your outstanding balance for debtors has increased this year, right? So there's more debtors outstanding this year than last year, which means that last year they paid you better. They're paying you worse now. So, ladies and gentlemen, you see what, thank you, Tanda, you see what we're getting at. So, really, what we are saying, there is more money. This is the way that I like to philosophize about it. What we are saying, because there's a bigger amount in our debtors this year compared to last year, more of our money is tied up in the debtors balance than last year, right? If more comparative to last year, if more of our money is tied up in our debtors, it means there is less money in our bank account. Does that make sense? I like the oohs and the ahs and the ohs. Exactly, Claire. Exactly. So then it is similar. I know these are not cash flows. These are now just the effect of the accrual system that we are eliminating it, right? But it is similar in principle to an outflow of cash. You've got less, well, you've got more debtors outstanding than last year, which means you have less money in the bank. So it is a similar principle to an outflow of cash. And exactly as Claire says there, so then we're going to show it as a negative. Let's look at the other argument, ladies and gentlemen. Let's say your debtors at the end of this year has got a lower balance. It's got a lesser balance than last year. Have your debtors paid you better this year compared to last year? Better. Thank you. Thank you. Claire, you are correct. Right. So compared to last year, thank you, Tembisa. Thank you, Siulisa. Yeah, I get what you mean. Right. So therefore, ladies and gentlemen, because the balance on your debtors account is lower than last year, it means there's more money in your bank account as a result of that. So that means it is similar to an inflow of cash. Right. So then you are going to show it as a positive. Right. Now let's go to inventory. Sorry, normally we do the inventory first and then the debtors. Right. So let's say there's a decrease in inventory. Let's just type it slightly differently. Decrease in inventory. Now, why didn't it type anything? Because I didn't open the window. That's why. Decrease. Okay, decrease in inventory. Let me just go back to collaborate. So, ladies and gentlemen, if we have a situation, again, to calculate the figure is very easy. You just take the figure in the comparative column for inventory at the beginning of the year. You deduct it from the figure for your inventory at the end of the year, which you find in your statement of financial position under the current year column. So to determine the figure is very simple, basic mathematics. You just deduct the one from the other. But now you've got the issue, should you show that as a positive or a negative? Now, even though these aren't cash flows, these are yes, you've got to, you're way ahead of me. I've got a lot of positives and pluses there. You're quite right. But I just want us to go through the argument for everybody's sake first. So if you've got less inventory this year than last year, it means less of your money is tied up in inventory, which in turn means more of your money is in the bank. That is why you are all correct with the positive and the pluses, right? More money in our bank because there's less money sitting in our warehouse, if I can put it this way, right? So your money is not part of the inventory that is sitting in the warehouse. There's more money in your bank account. So if there's a decrease in inventory, less of your money is tied up in the inventory, which means more of your money is in the bank account. If there had been an increase in inventory, ladies and gentlemen, if you've got more inventory at the end of this year than you had at the end of last year, it means more of your money is tied up in inventory. More of your money compared to last year is sitting in your warehouse or on your shelves or in your stores instead of in your bank account. So that would mean if there's an increase in inventory, we will show it as a negative, right? So it's similar to an outflow, right? So you're all correct. You all get the idea. Now, ladies and gentlemen, let's just do one more. I think I made a mess of that document there. Let me just see. That's where it went. That's why it disappeared a little bit earlier. Okay. So now let's go and look at the other side of the coin. We looked at the two kinds of current assets that deal with our operations. Now let's go and look at our creditors, the current liability that deals with our operations. So let's say there's an increase in trade and now we've got to talk about this. We've got to think about this slightly differently, ladies and gentlemen, because this is a liability. It's not an asset. So it's not our money that is tied up, right? It's not our money that is tied up. It is really, if you think about it, it is how much have we made use of the credit facilities that are provided for us by our suppliers, right? So if there's an increase, we're going to talk about, we're going to discuss this in two different ways, right? We're going to discuss this in two different ways, and I think Mrs. Moore and Mrs. Keys might probably do it a third way by using ledger accounts. We're just talking philosophy now. So if there's an increase, let's talk about this, the first rationale. If there's an increase in your trade and other payables from last year to this year, in other words, you owe more to your creditors this year than last year, have you made better use of their credit facilities or worse use of their credit facilities? Remember, we owe them more this year. There's an increase in trade. Yes, Vemanashe, right? Thank you, Sir Lise. We owe them more this year, so we've made better use of their credit facilities. We can also look at this in a different fashion, a second way. If we now remember, this is now a new question, right? If we owe more to our creditors at the end of this year as compared to last year, have we paid them better or worse? Have we paid them better or have we paid them worse this year if there's an increase in inventories? We have paid them worse. Okay, right. So we've made better use of their credit facilities, but as you all say, we've paid them worse. So, ladies and gentlemen, because we've paid them worse, it means this is going to be similar to an inflow of cash, right? We've paid them worse, we've made better use of their credit facilities. So this is going similar to an inflow of cash. So in this case, we are going to show it as a positive. A positive. Thank you, Claire. Exactly as a positive. Let's just look at the other side of the coin, ladies and gentlemen. If there's an increase in our trade and other payables, if there's an there was an increase, now the other way. If there's a decrease, in trade and other payables, right, it means, first of all, we haven't made as good use of the credit facilities that they have provided us, which in turn means if there's a decrease in our trade and other payables, we've paid them better this year as compared to last year. So because we owe them less now, it means we have paid them better. It will be similar to an outflow of cash, right? So in that case, if there's a decrease in trade and other payables, we're going to show it as a negative, right? I was waiting for someone to type for me negative. Right. Thank you, Lise. Okay, ladies and gentlemen, you get the idea. So this is basically the philosophy behind this statement of cash flows. We've looked at a few techniques on how we can find the cash flows. We had a look at the difference between the direct method and the indirect method. And we've already said that it only affects your cash generated from operations. So now, ESCOM willing, we will have hopefully a class on Monday. Then we are going to go further, ladies and gentlemen. Then we are going to put this into practice. So we are going to look at some of those questions in the question bank. In the meantime, please go and have a look at some of those questions. They become progressively more complicated, but the first few questions are really very, very straightforward. So anyway, we've run about, 11 minutes over time. It's not a train smash, ladies and gentlemen. So I'm just going to pause briefly for any possible questions, and then we can call it a day. Any questions from your side? I see I have a private message there. Let me just go and have a look at that private message. I won't mention your name because there must be a reason why why you send me a private message. Let me just go and read it quickly, ladies and gents. Um, can we recover this concept of positive and negative? Because okay, I almost mentioned your name. Sorry, but I didn't. Don't worry about it yet. Don't worry about it yet. Perhaps watch the recording again, listen to it again, and then especially when it comes to the questions. When we are going to do all this in a more practical sense, when we do questions and so on, I think it'll become a little bit clearer. I know it's a lot of um, ideas and concepts that's out there now at the moment. So we still need to make them more practical, and we'll use our various questions for that. But I think then the why it's similar to an outflow and similar to an inflow will become clear. But in the meantime, perhaps just go and listen to that little 5 minute or 8 minute or how long it was section of the recording again. Then perhaps that will help. But if it doesn't, then please raise the question again, either next week or whenever is appropriate for you. Right, ladies and gentlemen, thank you so much for attending. Any other questions? I'm going to give you maybe another 30 seconds if there is somebody who wants to ask something in person or type a question. Doesn't look like it. So then I'm going to say good afternoon to you. Have a lovely afternoon further.